Welcome back for another episode of Strive for 25. Joel Farrell here, and looking forward to sharing with you our. Welcome back to another episode of the Strive for 25 podcast. And I've got an amazing guest, somebody actually here in town, St. Louis, Missouri, Greg Iverson, and he is an entrepreneur. He's a real estate investor, also in the mortgage industry, and a lot to talk about today. But Greg, thanks for taking some time out of your day. And actually, you know what? Like, I keep getting text messages. It's opening day. And I'm a big baseball fan, but it's the last thing on my mind, to be honest. But thanks for making time for us today.
I'm not going to lie, Joel. I'm very excited to be on here, and I appreciate it. I did select this time before I realized it was opening day and that it would be 65 degrees outside. But hey, that's all right. We got more important things to talk about.
I mean, we could always reschedule if you want to drive down.
No.
Drive downtown.
This is more important than baseball. There's plenty of games to see this year. So yes, thanks for having me, man. I'm thrilled to be here.
Yeah. So just to kind of give our listeners a little background. So how long have you been in the industry, the mortgage industry, and how long have you been investing in real estate?
Yeah. So what are we? 18 years now. So 2005. I'll give you the quick story. So I got out of I went to Mizzou, got out of school 2004. I had no clue what I was going to do. I mean, I studied business finance. I learned all about, actually I didn't learn, but I was taught all about corporate finance and all these different things that were, fancy and exciting, but not relatable to real life to me at all. When I got out of school, the job market was lousy. And, so I really didn't know what I was going to do. I read a book called Rich Dad, Poor Dad. And it's funny, we did a fishing trip. It was my dad, my uncle, and my two brothers, and went trout fishing to celebrate my graduation. I think everybody was just shocked that I actually got out of school. Yes, it did take me 5 years, but I made it out and I got the degree. But anyhow, so we're there, and I love trout fishing, and I had this book, Rich Dad, Poor Dad. I didn't go down to the stream the entire weekend, and I'm a slow reader, but I read that book like cover to cover, and man, I tell you, the timing was phenomenal, because I, at that age, and Joel, it's like, you don't know what you're going to do with your life. You've got all these ambitions, but you don't even know where to begin. So anyway, I read this book, and that set me on that path of searching for financial freedom from like day one, not looking for a job, but looking for, a lifestyle and something that eventually I could separate myself from and enjoy, everything that life has to offer. So anyway, I read that book, and I went out and got my real estate license right away. At that point, it's scary to think, but I was able to get a broker's license before I had ever even done a single transaction. So I was a real estate broker. I had decided from reading Rich Dad, Poor Dad, I wanted to buy rentals. And so I started doing that. And as I'm sure you remember, 2008 comes around, the market collapses, and it was obviously luck, but perfect timing to start buying rentals. And I quickly realized I can't live on these day to day. I know that this is a long-term thing and it's going to work out really well, but I can't, at that time, I couldn't pay my rent or my mortgage, owning rental property. So I got into lending at the same time. And, for probably 10 years, kind of did both of those independently. I wasn't married, didn't have kids. So I essentially had two full-time jobs. I started with a line of credit. So I convinced my parents to let me take out a line of credit on the home I grew up in, on their house. My dad's a real estate appraiser, and he was all for the idea, was never a real estate investor, but was always intrigued by it. So he was all about it. My mom, I'm quite sure she still thinks the home is going to go into foreclosure, even though they've long since sold it. But she was much more afraid of the whole idea, the risk, so on and so forth. So anyway, I started buying foreclosures, rehabbing them, and then refinancing them, putting a tenant in, and, essentially rinse and repeat, known as the BRRRR method today. At that point, it might've been a term. All I knew is it worked once. I've got an obsessive personality. And so I did it over and over and over again. And so, fast forward, had about 75 rental units at the same time, building the mortgage business, which was is my, day-to-day job. And so, my wife, 2013, I guess it was the year we got married. She left her job to manage our rentals full time. We've scaled back a little bit over the last 2 years, but probably still today have maybe 25 or so rental units. Long story short though, man, I am in love with it. Just like the first day that I bought the first property and that I read the book Rich Dad Poor Dad, and you could testify to this, doing mortgage lending day to day, you see financials, you see borrowers' income, assets all day long. And we're lucky in the seat that we sit in, because I'll see all the time very, very high income earners that their balance sheet does not look very good. They have not focused on the net worth column, how to truly get ahead in life, the real scoreboard. And on the reverse side of that, have several clients that I wouldn't consider ever really highly paid, but took a different path, bought assets and built them over time, and realized that, investing in real estate is not a get rich quick thing, but you look at 5 years, 10 years, 15 years, and, it starts to snowball and really build something special, and that was always what I was after. And it wasn't for me, I want to get rich, I want to own a big house or a car. I wanted freedom. I wanted the opportunity that if I woke up one day and said, I just don't want to go to the office today, I'm not feeling it. Or if my kids have a field trip that I want to go to, I wanted those options, and that's what, focusing more on the balance sheet and focusing on, buying assets and investing and saving and budgeting over time. That's where the real power is. It's not growing your income. It's paying more attention to the net worth side of it, So it's been a fascinating, exciting, ride overall. But again, I'm still actively practicing it every single day. I bought a rental last week. I'm buying one this week, and then I think one here in a couple of weeks as well. So the power of time, and really in any market, Joel, I'm sure you get that question: is this a good time to invest? I think it's a great time to invest. I think you've got to be wise in the decisions you make, but I think you have to do that if interest rates are 2.5% too. Yeah. I think the logic still applies, and I think it's the time. It's not trying to time the market. It's time that you're actually in the market. You don't need to hit a huge home run on every single investment you make if you're committed, like Warren Buffett is, to owning it the rest of your life, to doing it, for the long haul. And that's where the real magic happens. And, things snowball over time. And all of a sudden you wake up and you look at it and you're like, wow, this is working. I'm sure glad I did that when I was in my 20s or 30s or whatever,
That's such an important point to think I want to dig a little bit deeper on. So, you and I have different journeys in mortgage and also in real estate. And I appreciate time way more at an exponential level than I did back then. I didn't really get it back then. But when you were, buying your first rentals and then coming off of reading, some of the books, including Rich Dad Poor Dad, doing fix and flips and quote unquote the BRRRR method, was the power of time and compounding, was that even something that was, a part of your vision, a part of your purpose at that point in time?
It's funny because I probably misspoke a little bit, Joel. No, it was not. For me, it was getting rich. And it's funny. My dad recently, we like to smoke cigars on my patio on weekends. And we were doing this about a month ago. And I forget how the conversation came up exactly, but he's like, when I asked you what you wanted to be when you got older, you said, I just want to be rich. Whatever that job is, that's the one I want. And his answer to me was, it can be anything. Chase what you enjoy and want to do. And literally any path you go, you can get there, And so, at times when I first started doing it, it was much more. And like you, I didn't recognize time because I had all the time in the world. I didn't have, kids' sports. I didn't have a wife waiting for me at home, so I had all the time on the planet. As time has gone on, that's what it's all about. It's getting your time back and doing what you want to do with it. And if you want to work, great, but what I've found, and hopefully you would say the same thing, I think over time, when you get to that point where either you've reached that financial freedom point, or you're headed there and you can see when you'll be there in your own mind, work becomes more fun. I talked to a dentist last week and he said, when I reached financial freedom, I fell in love with dentistry again. He's like, I hated it. It was a grind for many, many years. And then when that happened, I started loving it again. And it was like I'd just gotten out of dental school again, and that's how it is, I think, today, when you can do what you want. That doesn't mean you don't go to work or anything else, but you do it on your own terms, and again, you have children. It's like, if you want to, leave a little bit early, if the weather's beautiful, you want to go down to the Cardinals game today or go ride bikes with them. That's a lot more important to me today than getting a bigger house or buying a car or anything like that, and also the vacations and the memories that you can make. I know you spend a lot of time in Florida. I mean, I would have to believe that brings you a lot more happiness than, again, if you get a different car or get a new toy or something, that wears off.
1,000%.
Those memories, they don't, and we're not going to get that time back. My youngest is not going to be 3 forever, and,
Right.
and that's what it can bring you. And, so that was a long-winded way of answering your question, but it's definitely over time changed significantly in what the motivation is, for sure.
Do you have, so some of the first properties that you purchased however many years ago, do you own any of those still?
I do. Yeah. I sold a handful of them. The first one, I can literally still picture it in my mind. I wish I still own that, just out of sentimental value. But I can still think about the picture I took in front of the, for lease sign. And, it's really, it's super cool. Like, I think about the days, and I've already started doing it. My oldest is 8 years old. So they think I'm crazy, but I've already started to drive them around and say, this is a rental property that we own, and, so on and so forth. And I think the other powerful piece of it is our ability now, as we've educated ourselves on it, to be able to pass that along. Like, that's what I see as a legacy. It's not encouraging, unless you want to, for me, it's not encouraging my kids to go find a 9-to-5 job. It's to learn to be entrepreneurial and, learn the basics of investing and the power of time. If they start it when they're 20 years old and you already have them wired to understand being a landlord, they're going to be miles ahead of where you and I were at that point,
Totally.
And they don't need, the other thing I really like about it is, for me, it's very simple. If I want to go compete on Wall Street with hedge funds and stuff like that, let's be real, I'm not going to do it. I didn't go to Princeton. I didn't go to Yale. I don't have any of that, but I can compete in my own world and do well on very basic fundamentals. A 2-bedroom, 1-bath house. Like, that first one I bought was 2 bedrooms, 1 bath. It worked out swimmingly. It's not exciting. It's not, it's not a big skyscraper in Manhattan or anything like that, but little base hits like that over time, they just snowball and really start to amount to something.
That's so funny you mentioned that, the whole trading stocks or whatever, on Wall Street. Like, we had somebody on the show just recently, Gaetano Chambrelli. He's in Connecticut, and he's, I think, 25 years old, building a team, buying like student rentals, just doing all kinds of cool things. But his first job out of college was working on Wall Street, doing whatever trading desk. Did it for like a year. He's like, you know what? Not for me. And, don't want to have to compete. How do you compete in that world? And out here doing mortgages, building real estate, rentals and all that stuff, just doing his thing he wants to do.
Mm-hmm.
The reason I asked the question about, do you own some of the rentals from early on in your journey, is that, we're talking about 15 years later.
Yeah,
and
exactly.
The appreciation, can you kind of share a couple of examples of just purchase prices? Before you go there, the very first one you got, and you mentioned your parents' line of credit. What was that first purchase price? What was the
46.5? And it's funny, I talked to the guy's son earlier this week. He called me for a hard money loan, who I bought the very first one from. He was a wholesaler, flipper type. I paid 46.5. I put about 20,000 into it. So I had about 65, 70,000 into it. I guess that would have been appraised for 100,000 at that point in time. Now, that 100,000 started to do this a little bit, in that 08 to 2012 timeframe. But then I sold it. I forget when that was exactly, for 125,000. The whole thing, and it's not about the spread. So, I guess you could say then I made, 50,000 or whatever. It's much more so the power of leverage and the fact that I didn't have any actual money in that deal. I used that line of credit for that 70,000. I took a mortgage out, paid that line of credit off. I didn't have a dollar in the thing, and so what I'm super fascinated by in that whole thing is, again, it's a basic two bed, one bath home, 792 square feet is what it was. That can create a return that's essentially infinity, and the other thing, to go back to Wall Street, or just, people that, God love them and good for them, maybe end up on third base when they first come out of school. That wasn't the case for me. And I didn't start with a nest egg. The beauty of it and what I love about it is you don't have to, that those things like that are out there everywhere in front of us if we're looking for it. Like that house, if I really wanted to find a similar thing today, I could probably find something pretty close. Maybe it's not going to be 46,000, the numbers are going to be a little bit different, but I can find that, and I could do that without any of my own money, and you start to do that 10, 15, 20, 50 times. And I always tell my team here, it's like you're creating money out of thin air, and that's the super fascinating thing. And again, to go back to the stock market, for the most part, to do well in the stock market, you have to have capital to put in.
Yep.
Real estate investment, as I just described, you don't necessarily have to have capital to put in. And that's what I love about it.
Yeah. The example that we share a lot about is, let's say you've got 10 grand and you put it in the stock market and you get a 10% return. That's a great year in Wall Street. It's 10% of 10,000 is $1,000. Let's say you could also take that 10 grand and put it as a down payment towards a house and buy a house for $300,000, for example. And let's say that the house appreciates 3% in the first year. And, I ask the question to some people, and sometimes they get the answer wrong, and maybe it's $300 or whatever that a number is. And it's like, okay, well, 3% on $300,000 is $9 grand. Like $9 grand is way bigger than 1,000. And imagine if you take that over 10 years or 20 years, like the difference, right?
Exactly. It's all day long. And, it's crazy, the difference of it, and like you said, when you do it a number of times, it looks even better, as it snowballs across multiple properties and so on and so forth. Yeah.
So there's a lot to dig into in terms of the process that you've gone through and some of the things you learned and struggles and things like that, which we'll get to in a second. But just for the listeners out there, right here, right now, if you're out there and you have no money to your account, or not a lot, and let's say you got decent credit, decent job, and if somebody wanted to be able to get into the real estate game right now, if you were to insert your 20 whatever self into today's market, how would you navigate the markets right now to be able to get that first deal done? And obviously, you're probably gonna have to have some money in the deal in some regard. So how would you navigate that in this market right now?
So let's take out the blessing that I had of being able to leverage my parents' house, because that would be the first. But let's be real. Again, we don't all have that. And my parents are not rich people. They happen to be very, very frugal, had paid the house down. And that's what allowed me to have, to use their equity essentially to do that. But in the absence of that, what I know works is doing essentially the BRRRR method, just like I described, using, a private lender or a hard money lender that, to your point, maybe you end up with a little bit of money in it, but if you do it right, and I see it happen all the time. And again, I should say, there's risk in it. It doesn't always work out swimmingly. I'm sure we'll get to that. We've had plenty of bumps along the way. But there is the ability to use a hard money lender, to not have any of your own money in the deal, and still capture that equity, which is, that to me is the piece that we're really after. It's not as much the cash flow that comes with it. It's great if it does. I've always looked at it, and I remember my dad telling me this really early on, more from, being an appraiser and just understanding appreciation. But he said, you'll make your money in appreciation. It's, if you've got the cash flow, so you're not digging into your own pocket, that's what you want, but don't bank on, especially when you're in your 20s or 30s, living off of cash flow. It's the equity that's going to get you ahead. And that's been my experience personally.
I love it. Let's just kind of throw out a sample type of structure. Let's say in this market, like the first deal that you did, what it was in St. Louis, right?
Yeah. Yeah.
What
Right up
what what
by the
what
airport.
quadrant? Okay,
So it
by
was
the
in
airport.
St. Anne.
St.
Yeah.
Anne.
Yeah.
Okay,
Uh-huh.
cool. Um, so let's say that you're gonna, put a deal together, pick a price, pick a product. Let's say it's a hard money deal that you would do, or pick a deal that a structure or a tool that would get somebody in with a lower down payment. How would you structure that? How would you kind of describe it?
Yeah, absolutely. So, what hard money lenders are looking at, and really, even if it's a traditional, more of a construction type lender that you're using, regardless, they're looking at the ARV, the after repair value. And so we start with that number and we back into it. So to go back to that one that was worth 100,000, for instance, to be able to, knowing that if I had that 30% equity spread, I could get all of my money back out. That's where I started. Okay, if it's worth 100,000 and I put 70 into it, then that's how I can exit that, essentially by refinancing it and have no money of my own in the particular deal. So that obviously that was 2005 or whatever that was. That happens today. The numbers are different because the prices are different, but it's really looking at what that ARV, that after repair value, is going to be. And if you're able to acquire the property and make any improvements necessary, and you're leaving yourself a 20 to 30% spread in between, what the value is and what you owe or what you have into the project, that's how you can do it without money into it every time, and I could go on and on about what do you do after that, but at the bare, first base, day one, the first deal, that's what I would be after if I don't have a bankroll behind me or investors behind me or, family that's willing to help out. That's what I look for, because when you create that equity, obviously that's net worth creation, but that over time is then what you can borrow against to acquire other properties, and then all of a sudden that $100,000 property, that in my experience, it becomes a strip center, and the stuff like that I own, that was all financed from those original houses. That was, to this day, I don't think I probably have any of my own money in what we own. Now, again,
Awesome.
that's 15 years in the making, so I always tell people, I'm like, look, you're not going to wake up tomorrow and decide you're going to buy a Ferrari, move to Miami, and you're done. It's going to be a long, slow build. But again, little base hits like that every single time, all of a sudden you've got 10 houses like that. So you have 300,000 in equity creation. I remember looking at the balance sheet when I was 30 years old, and I was like, on paper, now I was cash starved, I needed income, but on paper I was a millionaire. And I'm like, this is incredible. Imagine where I'm going to be at 35, 40, and again, that's not coming from somebody that I always joke and say, but it's very true. I've got two brothers and I'm the dumbest of the three. I'm not a genius, but I found something that what I just described to you, and hopefully this, the audience feels the same way. And hopefully you do too, Joel, as well. That's not rocket science. That's not the hardest thing on the planet. Now, you still have to buy the right product. You have to make some good decisions, but the general mechanics of that, for somebody like me, that's not real hard to get my head around. If I can do that over and over again, I'm all in. Send me every deal you've got. I'm interested in doing it that way.
Yep. Yeah, and that's the thing, is that you're going to obviously have a lot of people on different kind of sides of the spectrum. Some people are very risk averse, some people are not, and everyone in between. And kind of talking to people and going through the process of kind of hearing someone's fears and hesitations and obviously the opposite side of the coin too. But there's everyday people that are doing it and getting ahead, and there are mentors out there. There are people like you and I that are happy to talk through the logistics of these types of things. I want to dig a little bit deeper on this, on just another example. So let's say you've got a property that you can acquire for $80,000. And from there, let's just say, it's a good deal at that price. It's called it a 3-bed, 2-bath, whatever location needs to be. What would the ARV need to be in terms, let's say you're going to put in $35,000 into it.
Yep.
So if the purchase price is $80,000, what does the ARV need to be to make the deal work, and how much money does the person have to put in upfront?
So basically, and I've
Oh, I'm
got,
sorry you didn't get my email memo. There are no calculators on this show. I'm just
I'm not using a calculator. Oh, here we go.
yeah, I'm just messing with you.
No, we're saying so basically we've got an $80,000 property. We're putting, say 35 in. So you've got 115,000 in it, right?
Okay.
So then what you want to back into is so that's going to be 75% of what, and where I'm coming up with that 75%, Joel, again, for those that don't do lending like you and I do every single day, that is what's required on a refinance like that. So if you take Fannie Mae, Freddie Mac guidelines, for instance, if you refinance a rental property, you need to have 25% equity. So that's where I'm coming from. There are other options there, of course, as well. But in general, if that property appraises for about 155,000 or so, then you have no money into the transaction.
Okay.
I can give you let's see, I'll give you one that I did just recently. I won't give you all the details because I did it a little bit different than this, but it would have worked out nearly the same if I would have taken more of that BRRRR strategy. I happen to just make the down payment and so on and so forth, but bought a property for 200,000 in Kirkwood, so I mean it's in our neighborhood here.
Yeah.
Appraised for 275,000 when I bought it, so again, it's what I just described of having 115,000 in a house that's worth 155,000. I'm very well aware that a lot of people are going to hear that and say, well, there's no way that will ever happen. And I understand that. It sounds crazy, but what I just described to you happened last month. It can happen. It might take looking at several different properties to really find one that fits and one that checks that box, but being able to identify that value and knowing that, buying it a little bit under the market or making some improvements in that property is worth even more. But that right there, that was equity creation that if I truly wanted to, I could have figured out a way to do that without any of my own money in, or very, very, very little.
Okay. So either that one or the 115 one. So purchase price of 80, or purchase price of 200. You pick. How much money would somebody need to be able to have? Let's say they're going to do what's a hard money loan or whatever the best option would be from an investment standpoint in terms of the lowest dollar in, and then can they finance the improvements, or how does that work?
Yeah, great. So I do hard money lending as well. So I'll describe it to you from, let's say you're bringing me you say, hey, I'm just getting started. I've heard about doing this. Would this work? So they pay 80,000 for the house. They put together their cost estimates, and it shows they're going to have 35,000 in improvements. So they've got 115,000 into the property. As long as it appraises for that 150, 155, you would go to a hard money lender. You would be able to get finance for that entire 115,000 that you have in the project, because the value is going to be that 155 or whatnot. So in that exact scenario, you could do that with no money out of pocket, using either, again, if you have the ability to take a line of credit against your own personal residence or a stock portfolio or anything else, or going to a hard money lender, you could do exactly that. And matter of fact, I mentioned St. Anne, that very first property. I probably did that 20 times in that same neighborhood, the exact same spot. Yeah. Again, not sexy, not saying anything negative about the neighborhood, but 2-bed, 1-bath, 800 square foot homes. That's exactly what people can do. And obviously I always say, I understand that was 2008. They were everywhere. I did have the advantage of timing that it was easier potentially to do at that point, but we still see our clients do it every single day. And I'm doing it today, but the hard money loans that we do for people, it's just what I described to you. That's exactly what they're doing. And they're either, maybe flipping that property, taking that profit, and that's what they're using. That's their nest egg and their capital to keep going. Or they're doing what I did and saying, I don't want to get whacked on taxes. I believe in long-term ownership. They're refinancing it, paying off their hard money loan, getting a tenant in place, and then moving on and calling that hard money lender when the next one comes around that's exactly like that and doing the exact same thing. over and over again.
Yeah, that's awesome. I mean, like one more detail on that. So let's say that somebody has literally no savings and they go to SoFi and they go get a $15,000 personal loan.
Mhm.
Can somebody use that on hard money for a down payment?
Yeah, yeah, they can. So hard money is it's private guys like you and I that we're not confined by guidelines of Wall Street or guidelines of secondary market securities, things like that. It's people with their own money that, and it's business to business lending. And so the guidelines are much more, I'm okay with this. Are you okay with this? Yes. Okay. Then that will work,
Versus the traditional lending route, residential lending route. Can you explain a little bit of kind of what
No, I'm
restrictions are
glad you
there?
said that. So you take out that SoFi loan for 15,000 and it's an unsecured loan. And I come to you and say, hey, I want to buy a rental property. This is my down payment. You're going to say, shoot, I wish you would have called me previously because that 15,000 you can't use because it's an unsecured loan, versus going. So that's the traditional route. Going to a hard money lender, the money's the money, it doesn't, I mean, I don't want to speak for all of them, but to me, that keeps my risk the same if you're putting that money in, regardless if it came from family or,
Right.
something else, as long as you can support that the payment on that, so on and so forth. But otherwise it doesn't matter where it comes from.
So that very first deal that you did in St. Anne, which by the way, my kids they have two boys that are 3.5, and they love donuts. They love Saturday mornings going to get donuts together. And my wife, she does stuff around the house or whatever, and her own stuff. And so we go to just us and the boys, right? And there's a place in St. Anne called the Sweet Spot. It's like right off of the near the Northwest Plaza area.
Yeah. Oh yeah.
Yeah. And so they have like the best donuts, the best variety. And then those are the ones that the kids, they love the best. Other ones they don't like as much. That's the spot. But anyway, but that very first deal that you got for, you said 45,000,
46.5.
40. What was, when you got finished with the property, what were the rents at on that first deal?
Yeah. It rented for
825.
Yep.
Okay. So you did the refinance, you got your money back from the line, they used from the line of credit. And then what was your payment on that?
So I was 70,000. Let's see here. Let's call it 70,000. And I did a 15-year mortgage. So it's 590.
Okay. So cash flowing a little bit there.
So a little bit of cash flow. Yeah. So I'm glad you asked the question that way, because to me, and taxes were of course lower at that point in time. I managed them myself. I think I had about $100 a month in cash flow, which if you're a cash flow investor and that's what you're after, you're going to pass all day long. You're going to say, well, that's going to take a lot to get me where I'm headed, or one thing goes bad and that 100 is gone quick. I looked at it again, maybe being naive or whatever the case might be, but it's worked and it still works. I looked at it as I just put $30,000 into my bank account, and obviously that's not the case, but I put 30,000 onto my balance sheet. I'm not paying any taxes on it today. I just created 30,000 in wealth essentially. And I'm doing it with a 15-year loan, and that's the other thing. If I put that on a 30-year loan, it would cash flow, a 20-year loan, it would cash flow. For me, I looked at it at, I guess I was 26 or whatever when I did that. I looked at that and 40 was I don't know why 40 was in my mind that I'm going to retire when I'm 40 years old. My dad had a friend at the time who unfortunately has passed away, but young guy who did incredibly well. And I remember my dad he was actually in the mortgage business. You would know if I mentioned his name, which I won't do, but started a good sized mortgage company here in St. Louis. Unfortunately, passed away in his mid 40s. But I remember my dad telling me early on, he's like, this guy could retire at 40 years old based on what he did in his 20s. And he didn't do rental property, but he built a business, same entrepreneurial mindset. And that was always in my mind. I'm like, I almost took that It's like, if you ever watched The Last Dance, how Michael Jordan will get a chip on his shoulder no matter what you say. You could say, hey, I love your shoes, and he's going to get mad and find an angle somewhere. Like, that's exactly what it was. My dad was not taking a shot at me or anything else. He was just speaking very highly of this guy. And I took that as a challenge. I'm like, well, then that's exactly what I'm going to try to do, So anyway, that was on a 15-year loan. And I looked at that as, okay, I've created $30,000 in equity out of thin air, and I'm, 25, 26 years old. That to me was all the money on the planet, but also knowing, okay, in 15 years, by the time I'm 40, this $825 a month minus property taxes and insurance, and ideally the rents would go up, which they have. I think that same property probably rents for $1,100 today. That's all then going to support your lifestyle, and so that's why I did the 15-year mortgages. And if you don't mind me going down one little path real quick,
Yeah,
I brought up that the Kirkwood house that I just bought. Now, again, this just happened, so we don't know what appreciation is going to be, but I've been on a kick lately on how do you finance your children's college by buying rental properties. And I wanted to make it super simple. And so what I did was I took that $200,000 house and I put in and I did a 15-year loan on that one as well. I figured what the appreciation would do over the next 15 years. So my youngest is she's about 3.5 years old. So she'll go to college in 15 years. So I looked at this property and I'm like, can I get this one house to fund her college? So I started digging deeper, and I figured that with, reasonable appreciation, I think I used 3% appreciation, maybe 4%, which I think you can reasonably over a long period of time count on that. But anyway, I figured that house would sell for somewhere around $400,000. I think it was like $415,000 in the year 2038. So 15 years down the road. If I pay commissions, pay some taxes, I've got enough to send her, if she stays in state at a public university, which she better do, I could pay for that college twice with that money. If she decided to do out of state, I could pay for it. If she decided to do a private college, I think I figured in 2038, a private college is going to be about $370,000, I think, for 4 years, something like that. It would darn near pay for a private college, that one house in Kirkwood, so you think you've got two boys, like two houses. So if everything else goes bad, and I remember describing that again on my patio, having a cigar with my dad, I'm describing that to him. And he says, man, I wish you would have taught me that when you were 3. He's like, if you would have told me that when you were 3, when you and your brother were going off to college. And of course, my brother, who's significantly smarter, he picks this private college in Florida. It's in paradise, but cost a fortune. He's like, man, when that time came around, for me, it was like, oh boy, what are we going to do now? I'm staring at $500,000 for you two to go, and I'm not ready for it. I didn't plan on it, and so to me, it's so easy to think about it today. Okay, one house. All right, her college is checked off the list, and obviously I described some of the other properties that I've owned and stuff. All 3 are done. College is done, and I don't say this to brag, but I think about it, and it's like, because of doing those St. Anne houses early on, before I was married, before my kids were even a thought, their college was already paid for, and so you go back to that whole, freedom in the time and just overall, Joel, I think operating in a calm fashion, and being comfortable with where you are at today, it's incredibly comforting to me to know if I walk out of my office right now and I get hit by a car, my kids, they're going to miss me. There's no doubt, but they're going to go to college. Things are okay. It's not going to be, oh man, that changed the course of their life because I didn't think about that stuff sooner, and that's incredibly powerful to me. It almost brings tears to my eyes at times when I think about that, because it's like, here we are, 2 average dudes, sitting on here talking, and doing things like that can change the course of your family. By buying a house in St. Anne and renting it out, or buying that house in Kirkwood and renting it out. I just think it's super cool. And if, my day job doesn't work out well or whatever, again, it's very calming to me to know that's covered. And that's what makes my day job a lot more fun. Then it becomes more of a game, not, I have to do this. so my kids can play sports today, or, go to whatever school they want to go to, or that kind of thing.
Yeah, totally. Like, you and I, we're talking to people every single day. And, I started counting the times I heard the word crash. Cause like around January to December, I started hearing the word crash a lot. And you're hearing it on social media, you're seeing it in the headlines on whatever else is out there. And, I started counting this in January, and I was like, okay, the people that are under 40, I think January was like 25%. March was like 35% of the people in that age demographic will use the word crash. Is there going to be a housing crash? Well, I heard there's going to be a housing crash. And who the hell knows, right? But a lot of the data about inventory and markets and all these things don't really indicate there could being a big housing crash, because nobody's selling. People have a 3% rate or 2.5% rate. They're not selling.
Mm-mm.
So if somebody wanted to be able to get into the game right now, and you mentioned cash flow and also appreciation, and it's tough to find a deal that's on cash flow right now. So getting into the mental standpoint of buying a rental, and maybe the numbers aren't perfect. Can you share a little bit about that in terms of just what are you seeing out there? What are you seeing people do out there? How are you seeing, newbies or regular people coming into the game, and how are they analyzing this stuff?
Yeah, and I'm glad you asked, because I talk to my team here about it all day long, because we work with a lot of investors, so I want them to be educated and understand. And also, I want them to know my opinions and how I feel about the whole thing, and for me, and you, by the way, you will talk to plenty of people that will tell you I'm crazy and you've got to have cash flow and things like that. For me, that's not the most important piece. And that's why I'm not afraid to buy in this market, because I think the long term, the home runs in terms of getting ahead and creating creating net worth, essentially, it's in that appreciation. It's that house that I mentioned in St. Anne that 15 years go by, it's paid off, it's free and clear, and it's worth twice what you've got in it, or what it was worth when you bought it, type thing. I think that even in this market, you can do that. There is no doubt about it. And really, to that, I would also say, and Joel, you've probably seen the same thing, rents have gone up considerably over specifically the last several years. And that's helped to stay in tune with interest rate increases, property tax increases, inflation in general. Everything's more expensive. I still find that there are properties that do cash flow. It's just not something I'm laser focused on. I'll give you a quick example. I bought we're on a show, so I'm not going to use the language I should, or I want to, but it's a piece of junk. I'm sitting in my office. The reason I point here, because it's 2 buildings down from me. It was an old tire shop. Not something you would say, man, that is a piece of real estate I got to buy. But it's on Manchester Road. For those that are listening, that's a major thoroughfare here in St. Louis, highly trafficked. Anyway, I buy this property because I think the appreciation potential is huge long-term in it. So I paid $290. This was about a year and a half ago. It does not cash flow. It's been sitting there, quite honestly. I thought I want to use it for myself. I don't know what I'm going to do with it. My point in telling you that, I got an offer just, probably 2 weeks ago to sell it for $415. That's a home run. I figure what it's cost me to carry it for a year and a half. I've gotten no cash flow on the thing, but I can, essentially walk away with 100,000 or whatever the gain would be. That's a home run to me. I like to look at that as, okay, that's 100,000. Let's say I've owned it for, let's call it 18 months, for instance. Again, I'm not using my calculator. I'm just, I'm thinking. I was paid $5,500 a month to own that property. Like, if you think of it that way, in terms of the appreciation, by buying that property, I was paid $5,500 a month. Again, not a property you would drive by and be like, oh yeah, I got to own that thing. That's it.
And
right there.
you said it was a tire shop?
It was a tire shop. Yeah.
Tire shop. Okay.
Yeah, just very basic, 2,400 square foot, all concrete block, just a very industrial basic building. The area and knowing that, things will only get better and there's going to be redevelopment and things. In my gut, and fortunately appears to be right at this point, in my gut, it would always appreciate and it would have significant demand regardless of what the rents bring. And that's obviously a very extreme situation. Buying my first property, I would not have done that because it cost me $2,000 a month or whatever it cost me to carry it every month. I would not have been able to do that. But that kind of stuff, it's the same concept at the end of the day. It's not being laser focused on, I've got to make cash flow today, I can't buy in this market. To me, it's the time. It's getting into the game and then letting time do its work. And if you're buying in the right properties in the right areas, yeah, we might hit a crash. We might hit, a depressed market, whatever. They'll always go up in value if you hold them long enough.
Yeah. And that's the thing is that you mentioned, the Kirkwood property, you buy it for $200K, it appraised for $275. And, that's going to be able to, basically pay for your daughter's college. Right.
Yeah.
And like that scenario, maybe you do some work to it. Maybe you renovate it and it appraises for higher later. I don't really know. But like the first example where you got in with no money in, it's like, can you imagine paying for your kid's college by putting literally $0 in, just by putting the time in to know the game? And to know the game, you have to start where? Somewhere.
You have to get in it. You've got to talk to people that have done it, I think you've got to talk to people that are credible, but also transparent. I mean, I'm not fluffing anything. I'm literally speaking as somebody that's just as shocked as you probably are hearing that it worked. I'm just as shocked knowing that it worked, Yeah. And yeah, I mean, anybody could do something like that, and going back to that cash flow example, I mean, the cash flow was not great on that, but do that 10, 20, 30, 40, 50 times, whatever your appetite is. And that 30,000 each property, not to mention every year that goes by, at one point I remember looking at it and just the loans that I had, and this was a ways back, but the loans that I had, I was paying about 100,000 toward principal across the portfolio in a given year. I looked at that as I made 100,000 that year because you did. I mean, you created, net worth of 100,000 in that year only by paying the mortgages down. Mm-hmm. That's not figuring any cash flow. That's not figuring that they're appreciating, which they do. That's just in paying down those mortgages. Multiply that times 2. It's 200,000. And the other beauty of it, which we won't go all the way into taxes and stuff, but I didn't have, so I created that 100,000 in, net worth increase in that given year, for instance. I didn't get a tax bill for 30,000 or 20,000. I didn't get any tax bill, and I think that to go back to the entrepreneurial and the, rich dad, poor dad whole mindset, that's what it's all about. If you do that in your ordinary job, you're getting whacked. You're paying 20, 30, 40% in taxes all along the way, every single time. Instead you're building this thing over a, 5, 10, 15, 20, 30 year period, whatever it is. And you're not paying a tax bill all along the way that's eating into that equity and that gain.
Are you a cost seg person or no?
Only on the bigger stuff that we've had, have I done that? I went through the exercise a few years ago and I was told, and it's probably changed, or I may have gotten, maybe not the best advice, but, what I was told at that point, the smaller properties I had, what it cost to do those cost seg studies, were not a benefit to what I could gain with bonus depreciation. It was more on the bigger commercial, type properties. I've done it a couple times, but only on the bigger
one
stuff. Yeah. I've done 1031 exchanges. That's cost seg is great. Bonus depreciation is great. 1031 exchanges, that's one of the best tools that I've been able to use over time.
Can you share a little bit about that just real quick? Just
of course. Yeah. So let's go back to that St. Anne house, the very first house. So actually this is funny because That St. Anne house, that was sold to buy this building that I just described to you. This building and a house
Oh,
right behind my office here.
the tire one.
I used the proceeds to buy
Okay.
those two properties. Yes. So anyway, 1031 exchange. So what I was able to do, which anybody can do, is the gain on that sale of that house in St. Anne, by not taking that money myself, not using it to make upgrades to my house or whatever, go on vacation or something, by rolling that in and buying additional long-term hold rental real estate with it, you can defer your tax liability. So on that particular house, yes, there was a gain there. I have yet to pay any taxes on that gain because I rolled that into another investment, another long-term investment.
Gotcha.
So again, you go back to this tire shop. So I'll just give you a couple more numbers, just hopefully they're fascinating to you, but that tire shop was acquired, again, no money. We go back to the St. Anne one. I didn't put any money into that. I used that to buy this one. And now all of a sudden that's created, that additional gain on that property, plus the one that I did with it behind the office here. Maybe not quite as, the numbers might not be quite as good on as the tire shop here, but they're still good. And it's only been a year and a half too.
Yeah. And the cost of living, inflation, I think I saw a recent stat that like 50% of the working adult class out there, don't have more than $1,000 saved. And at the same time, though, I keep saying that this is the most recession-proof, culture that we ever had. I mean, people coming out of COVID are making money in so many different ways. And so if someone loses their job, okay, that sucks, but there's probably going to be some other ways they're going to be able to generate income and earn income. And so,
Absolutely.
if somebody sees this and sees the vision and believes in what's possible for the long term, and they don't have money put away, there are ways to be able to get in the game. And I'm seeing people, build businesses on the side, consulting, the list goes on.
Yes.
And if you want it, like you mentioned before, with the Last Dance, the Jordan type people, that mindset, if you want something enough and you keep working at it over and over and over and over, every single day you put a little bit of work towards that vision or goal, at some point you're going to figure it out. And people taking that second job or side hustle or whatever and just stockpiling cash and then buy that first property. And, I love the example that you're talking about of getting into, because yours was a straight investment, right? At a certain price point. And,
yep.
Just getting into the game, it can be $100,000 property. Maybe you buy it as a primary residence, you put 3% down, or maybe even do a grant or whatever, getting in the game, save up, buy the next one for 150 or 175 a couple years later, and turn the old one into a rental. I mean, it's a lot easier said than done, but so many people are renting and are okay with renting. But at the end of the day, it's an opportunity.
I'll give you a couple examples, but one point I want to hit on that you just mentioned. It's the other piece that it's always been incredibly calming to me is I can't be fired from it. If there's ever a disagreement with a boss or there's a downsizing, I mean, we're in the mortgage industry. There's been a big downsizing in the last, 9 months now. You can't be fired from owning your rental property. That's a very calming thing that I can look my kids in the eyes and know, hey, if I do something stupid, if somebody doesn't like me or whatever happens, we're cool. Everything's going to be okay. And I love that. Yeah, I can make mistakes, but I control my own destiny at the end of the day. Like I can only blame, if I make a mistake on that St. Anne house, whatever, I've made millions of them, obviously. All I can do is blame myself. And that is, I like that. I would rather be in that position than I blame the mortgage industry or I blame whoever caused rates to go up and a bunch of downsizing and layoffs in the mortgage industry. That it is what it is. There's nothing we can do about it.
Yeah. So when you mentioned the story of, smoking cigars with your father, kind of looking back at older times and talking about, well, yeah, I want to be rich. Why you want to do X, Y, Z? Yeah, I want to be rich. To put that into more clear words, is it controlling your own destiny? Would you think your 22-year-old self would have used those words that you just used, controlling your own destiny? How would you have painted the picture back then, if you can remember? How'd you describe it more?
You know, at that point in time, it was, you know, it's a little tough to say, quite honestly, because it was so long ago. But at that point in time, it was much more around the the I guess the me talking to you today, the bad reasons to want to get ahead in life and be wealthy. Quite honestly, you know, it was, I want a big boat. I want, you know, to go to the club and buy everybody's drinks. You know, it was legitimately, that's in my mind, that was wealth. That was being rich. As time has gone on, that ain't rich. You know, rich is whatever, however you define it. You know, rich to me today is driving my kids to school in the morning. You know, rich to me is to know that when we get off of this, it's a beautiful day here. I'm going to be on the street with my kids watching them ride their bikes. Like, that is rich. Rich is not sitting down at the dinner table tonight, sweating over, are we going to make the mortgage payment? You know, or are we going to be able to go on a vacation? Am I going to be able to give them the type of life I really want to? That's rich to me today. It's not, I mean, I've got a Jeep Grand Cherokee. It's nothing fancy, you know, that's rich.
I love that.
I mean,
love that.
To know I could buy a better car, but it brings me no satisfaction, so I don't run out and do it. That's rich, you know? And so I think it's, and I always tell people, I'm like, you know, before you go on an endeavor like what I just described over 15 years of, you know, buying these homes, I mean, we've had eviction, you know, there's plenty of roller coaster rides along the way. I always tell people, I'm like, you've got to be very clear on why you would want to do what I just described. And if you can't, you know, and again, yes, I was doing it for the wrong reasons, but I was pretty clear back then on why I was doing it. I just don't agree with it anymore. You know, if you're not clear on why you're doing it, you're just not going to find the satisfaction in it. You know, I remember I was, my wife and I, we were still dating at the time. And I remember we were going out to dinner, and I got a call, and it was April of that year. And we had like 4 basements flood, which, as you know, that's not good. That's going to cost a lot of money. You're going to have to figure out, where's it coming from? It's going to be a big, you know, a big bill for sure. And I had the call, blah, 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 hang up the phone and go back to the normal conversation. I vividly remember her looking at me and saying, how are you not even fazed by that? That is horrible what just happened. Like, I'm over here about to freak out, and I have nothing to do with this. And I said, you know, I've never thought of it this way, but the light bulb went off right away when she asked me. I said, because I'm clear on what I signed up for. Like, if I'm going to take the good and you know where I'm headed, there's some bad that's going to come along the way. And that's what I signed up for. And that's all part of it, you know? And I think also, and I talk to real estate investors about this all the time, if you're super, super clear on that, you're not going to get knocked out of the game at that point. You know, many, or if I was just doing it and I wasn't passionate about why I was doing it, when that call came in, I probably would have said, sell them, I'm out. Done. It didn't work, you know? Instead, so, well, if I'm going to have good days, I'm just going to have to accept that the bad days are going to come too, you know? And that's how people, I talk to investors all the time about that. It's like, I was talking to a guy yesterday who was describing some challenges he's had on 2 particular properties. And he called me just because he wanted me to calm him down, you know, and center him on what he was doing. And, you know, at the end of the conversation, he's like, man, I'm super good. You know, I got on this call about to just panic and jump off a bridge. He's like, now after talking through it and understanding it, I'm totally cool, you know? And that's exactly, I said, Jeff, you know, hopefully you didn't get into this expecting it would be the easiest thing on the planet, or everybody would do it. You know, you have to have a little bit more of a stomach for that if you're going to take part in the upside of it, you know, and accept that that's just a part of it.
Yeah. I mean, as you're talking through that and, you know, being very clear and understanding what you're getting yourself into, and, you know, being happy and seeing success and being, you know, quote unquote rich, what makes somebody feel like they're in a good spot and whatnot. Like, Gary Vaynerchuk is on social media and he's talking about this over and over and over. They're like, success is just waking up and getting out of bed and being happy and excited about what you're going to go do in the day. And if you can do that every day, like, holy shit, like, it's pretty freaking awesome.
You know, Joel, I remember people telling me that like early on, and I'm like, that's a bunch of hocus pocus. No way. But that's so true, like as you think about it, it's like, yeah, if you wake up and celebrate that the sun is out today and that you got your kids to school and they're healthy and safe, yeah, every day is going to be pretty good. When you think of it from that lens. I mean, it's so true. And he's obviously out there. He's insanely successful. So it's oftentimes maybe easier for him to speak to that than others, but not necessarily. I mean, I could honestly say I'm probably just as happy as he is.
Right.
My
Right.
definition is different, and that's okay for both of us.
Right.
But I hopefully that appeals to people that are listening, that you don't need to do what I did. You don't need to do what Gary Vee does. You don't need to do what Joel does. But if you're clear on what makes you happy, go in that direction. You can make it happen. And reality is, it takes money. That's the other part of it. That money's not everything in the world. But got a guy that tells me all this all the time. He's like, but it does make the problems go away pretty quick. If you're clear on why you're doing it, and you're able to then navigate the tougher days, then it does make it a lot easier. There's no doubt about it.
I think earlier on in our conversation, you mentioned, seeing the blueprint of, the first property working and then rinsing and repeating. I think you used the word OCD or obsessed. Did you use that word? I forget.
Yeah. Oh yeah.
So the reason why I bring that up is that kind of combining that with the Last Dance and Jordan. Like, Jordan was so clear about what he wanted to do. He wasn't going to let any obstacle or any hurdle knock him down. He's going to get back up and shoot for a certain level of excellence. And like, I think they showcased it in that show, the guy from the Bullets, where he, like, the rookie scored like 40 points or whatever, and like said something on the way off the court, and then they play like a back-to-back in the other city, like the next game. And then Jordan went off and like scored like 50 points or whatever. Exactly. And I think the word is, I think LeBradford Smith, maybe is what his name is. LeBradford, LeGrand.
I forget who it was. I remember exactly what you're talking about though.
Yeah. But he made the story up. Yes. He made the story up.
Exactly.
Like, it wasn't even a real story. And he's like creating these things to fuel himself to be able to get to these higher levels of thought or high levels of whatever you want to call it. It's just, that's the stuff that's just so interesting.
And so we can relate that to, whatever it is that's motivating you. Like, you can literally convince your mind of whatever the heck you want, just like he did. And if he knew that that's what it was going to take to motivate him, then he's going to do it, and it's going to work. And again, then there are no roadblocks. It's only opportunity that you see in front of you.
Yep. We're running out of time here. So for the audience out there, if they want to reach out to you about advice, real estate investing, hard money, mortgage stuff, what's the best way to reach out to you and get a hold of you?
Yeah, I would say, and we'll probably include my contact info somewhere, but really just call me. I'm very basic. My technology, as you saw me trying to get on this Zoom, is lousy. My number is 636-751-1068. You can find me on social media. You can find me other places. If you want to have a real conversation and talk, call me. That's
what is it again? 636 what?
Yeah, 636-751-1068.
Okay.
That's where I think you get to know people. That's where I think you get the good advice, is you talk to people. You offer, hey, I'll buy you a cup of coffee if I can just pick your brain for a little bit. That's what I've done time and time again with people. I think when you find people that have achieved something that you're after, they're a lot more transparent and willing to share, I think, if you approach them in the right fashion, and I've done that many times. I just say, hey man, I'm impressed with what you've done. I'd love to talk to you about it. Yeah. Some people have told me I'm a creep, go away, get lost, whatever. But man, a lot of them have said, yeah, cool. Let's do it. I'd love to, and I do find that people that have reached some sort of achievement or some level of success in their life, they do want to see other people do the same thing. And they're an open book and willing to share. Not everybody, but they're out there.
Did you have somebody, like, along your journey? You mentioned your dad wasn't an appraiser, but not really an investor. Did you have somebody along the way that was a mentor, or you're able to rely on, or just going solo?
That side of the business, I did not. I wish I did, Joel. I believe in coaching big time. At that point, I did not. And I can tell you I'd be miles ahead of where I am today if I had. In our other businesses, in my hard money business, I do. In my mortgage business, I've got others that have done the things that I want to do. And so it's as simple as getting to know them and repeating exactly what they do. On the hard money side, I was fortunate. The first company I went to work for in the mortgage space, those gentlemen had started the company pretty young. They sold it in their 40s. They got out of the industry and they started hard money lending. And so I did almost just what I described to you. They live in Houston, Texas. I called them and I said, I just want to fly down for a day. I want to learn what you're doing and you can school me. I spent one day with them. They taught me hard money lending in 12 hours. I got on a flight and I came back to St. Louis and that kind of set me on that path. Just that 12-hour day, I was able to structure the business and know how to do it. Now,
That's awesome.
Of course, I do, yes, call them still from time to time. Hey, what would you do here? I still get advice, but just reaching out to them and spending 12 hours in Houston, Texas in one day, again, changed, the course of a lot of things. And
I mean,
you have to be humble, I think, to do that. I do find that people at times, they can't get out of their own way, and how do they know more than what I know? I'm the opposite. I'm like, I assume most know more than I do. So I'm going to try to pull something out of them that I possibly can. And in turn, we talked about coaching. I've coached hundreds of loan officers to teach them some of the things that I've learned. And I don't do that to get rich. I don't do it because I get a big paycheck, but it's pretty darn rewarding to show somebody the basic, simple stuff that I've learned that's worked. I love that. If somebody calls me and says, man, this is the year I had because of some of the things you taught me, like that, I love hearing that. It's awesome, because somebody did that for me, and somebody continues to do that for me every day.
Yeah. I mean, when you say that the service you can give to a client, whatever it is, by building a business and hard money and real estate investing, that journey, and then also the coaching, like the value that you can provide to your clients is going to be exponentially higher by going through all that stuff. I would imagine, right?
I think it is, Joel. Like I know that you have, short-term rental in Florida, for instance. You could teach me about short-term rental because you've done exactly that. Like you've walked in those shoes, and that's what we, around our office, we talk about. Like that's our secret weapon. Is I'm not advising somebody to buy a rental property because I'm a good salesperson. Period. I'm really not a good salesperson, but I'm advising them to do exactly what I did. Because that's what I know, and I know it works. And so I think that's the thing, and there are a lot of open books out there if you look around for them. I know I could call you and get advice on running a mortgage branch, and you'd take my call and say, here's what I would do. Here's what I would change, man. You're not going to say, no. You're going to say, dude, I mastered this. I want you to learn. I want to teach you. And in turn, why don't you teach me how to do this? And it's a two-way street. And I would never look at that as, oh, you're a competitor. Oh, what are you trying to take from me or something? It's more like, what can you learn from me and what can I learn from you that make us both better in the end?
Totally. And the reason I asked the mentor question is like the same thing. Like I didn't have a mentor. I just read some of the similar books that you've probably read and just did it on my own. And like in 2017, I bought a couple of 4 families in South City, and they don't cash flow well. They're old and they have all kinds of expenses. But the whole equity and appreciation thing, like in 2022, I did a reappraisal of it. And it's like, holy shit, that just doubled in value.
Yeah.
Okay, then. It's like things that you don't even realize, but just by being in the game, like opportunities opened up. And like the mentor thing, it's like, if I could tell my old self something, which I hate this question because it's like, well, what would I have done if I knew this 10 years ago? It's like, well, you probably wouldn't have done anything with the information because your brain wasn't ready to take the information in, right? Failures and struggles change the way you think about things. It's like, go find a mentor and don't stop till you find a mentor is what I would probably tell myself, but go ahead.
Well, and I always think about like the, what do they say? When the student's ready, the teacher will appear, there is a lot of truth in that. But if you were to pose that question to me, what I would do differently, that mentor piece would have been it. Again, we don't have enough time today to go into it, but I shared with you the successes and the excitement of it. I promise you there are many, many, many bloodbaths along the way that have not been fun. You can't really actually see it all that well here, but my hair's getting pretty gray. My beard is pretty gray. There's
Okay.
been a lot that's happened along the way. That my point in saying that could have been avoided if I had humbled myself early on and said, you know what, this guy has 100 rental properties. Why don't I just ask him how to do it? If that's where I want to go, why don't I just ask him what he did?
Yep.
Just like the conversation we're having right now. If somebody said, I want to figure out how to build a rental portfolio and I have no money today, I would describe to them exactly what I just described to you. And, it's real life. I'm not, here's what could happen, or here's what I hope would happen. Here's what did happen and does happen,
Yep. And see, that's why I love talking about this stuff, because you're going to have a range of people. Some people are never going to want to do what X, Y, Z. Some people are thinking about it. Some people are all like, I want to learn. It's like having these conversations and putting more and more of that stuff out there that let people know, hey, there are resources to be able to get some advice and, know the roadmap. And we've had a few people on the show recently that just open up my eyes in terms of just the age part of it. Cause the kid on here, his name's James Bracken. He's 19 years old and he's got a top 2% podcast in the world. He's 19 years old. He's just doing it.
It's awesome.
Yeah. And
you know why he's doing it? Because there's not that what's in so many of our own minds. No, I can't. I'm only 19. I can't do it. For whatever reason, that isn't in his mind. He couldn't care less. And so that's why he's doing it. I mean, yep. I assume he's talented and smart and everything else, but reality is he doesn't have a mental block that says, no, there's nobody that's 19 that's out doing it right now. So wait till you're 30 to do that.
Yep. And that's the thing, from a podcast standpoint, there's 3 or 4 million podcasts out there. And there's stats that come out that only, I think 30% do ever get past the 4th episode.
Yeah.
So right there, you're already going to be in a top whatever percent. And 256,000 are releasing 1 episode a week in the last 90 days. And so by default, I started this in September. By default, by just continuing to do it, even if it's shitty, it doesn't matter. I'm in the top 7%. If you do the math, I'm top 10%, bro.
It's awesome.
Just showing up.
Yeah, exactly. By committing to doing it and doing it, and maybe on those days when you're like, this isn't top 1%, it's not working. You just said, I committed to doing it. I'm going to keep doing it. It's the same thing in what I described in real estate. When the bad days came, that's what I decided I was going to do. So I kept doing it. When most said, this ain't working, I'm out. That's when I was like, oh, sweet, let's do more. The market just depreciated. And, to go back and then we can, of course, wrap up. But to go back to, earlier on, if we do see a crash, I almost start to smile when you say that, because to me, that's opportunity, and I don't pray for a crash. I don't want bad things to happen, but I see that as, okay, that's an opportunity to do it all over again, and when others are going to be fire selling everything in a fear and a panic, people like you and I are going to say, I remember when I drew the plan up, and this is literally the day that I was waiting to come around when I figured out what my plan was going to be. Now's the time to do it,
Totally. So last thing, 2023 goals. What are some of the goals you're trying to be able to get to this year?
Oh, that's a great one. So, in mortgage production, I want to do 100 million in loans, closed and funded. That's my goal in my day-to-day job. I want to acquire 20 new properties. I'm about 4 in now, so I've got about 16 to go this year. I want to build our hard money portfolio about twice the size of what it is right now. I would say those are the biggest things, but at the end of the day, if none of those come true, I would say the biggest one, and it is literally almost 4:30. It's that I leave the office at 4:30 every single day, and I'm there for my kids. I go from here to the gym to home by dinner time. That's my biggest goal. I committed to doing that several years ago. I do it pretty much every single day. And if I look back at the end of the year and those first 3 goals I gave you don't come true, but I left the office every day at 4:30, that was a successful year. for sure.
That's awesome. And for the listeners out there, so you live in St. Louis. You're married with how many kids?
3. Yeah, 8, 6, and 3.5.
Cool. And what's your favorite restaurant in St. Louis?
I would have to say Annie Gunn's. We never go. It's gotten so I don't drink, so we don't really have an alcohol tab at dinner, but it's gotten so expensive to go out anymore. Annie Gunn's is my favorite. But I like to go to the Hill, man. I like to, the original old Italian restaurants. I love them. Joya's is one of my favorites to go on a Saturday afternoon.
I love and they have a good deli too. Yeah.
Oh my gosh, I could. That could be a whole nother podcast episode,
right?
Talk about that all day long. One of my other goals is to be able to eat like that and not look like it. So that's another goal for the year.
Cool. Well, later in the year or sometime down the road, we'll be talking, and maybe even like talking after maybe a Cardinals World Series. I was just talking to a gentleman that's a Chicagoan that we were laughing about the Cubs and Cardinals and White Sox and blah blah blah. So maybe a Cardinals playoff run that'd be cool. Use that Goldschmidt and Arenado prime years. We'll see.
Heck yeah! Oh, that'd be a blast.
And I hear him talking baseball while we're sitting here. On our computers.
We're missing opening day. They owe us some playoff games to go to come fall that we can actually make it to. Yes.
Cool. Well, I'm gonna let you go. It's your 4:30 time, but thanks for making time. Looking forward to it. Down the road, want to dig deeper on some more rental property stuff, strategies, and maybe share some examples down the road. So
love to, man. Anytime. Cool. Yep. All right. I appreciate it very much. Thanks, Joel.